Investing in Canada while living in the USA offers many advantages. First, Canada has a stable economy. It is known for its strong banking system and rich natural resources. These factors contribute to consistent economic growth. Investors often look for stability and growth, making Canada an attractive option. Another benefit is diversification. By investing in Canada, U.S. investors can diversify their portfolios. This means spreading out risk by investing in different markets. Canadian industries such as energy and mining offer opportunities that might not be available in the U.S. This can help balance a portfolio during economic downturns. Canada also offers a friendly business environment. It ranks high in ease of doing business. The government supports innovation and trade, which attracts foreign investors. This means more investment opportunities for U.S. investors. Moreover, the Canadian dollar often fluctuates differently from the U.S. dollar. This can be beneficial when the exchange rate is favorable. It allows U.S. investors to potentially gain from currency differences. However, this also requires careful attention to exchange rate trends. Investors have several options when considering Canadian investments. Stocks are a popular choice. The Toronto Stock Exchange, or TSX, hosts many established Canadian companies. Investing in Canadian stocks can provide exposure to industries like technology, finance, and natural resources. Mutual funds and exchange-traded funds, or ETFs, offer diversified investment options. They include a mix of stocks, bonds, and other assets. These funds can focus exclusively on Canadian markets, or include international components. ETFs in particular often have lower fees and are easy to trade. Real estate is another promising avenue. The Canadian real estate market has shown remarkable resilience. Investors can purchase property directly or invest in real estate investment trusts, or REITs. REITs allow investors to access the real estate market without owning physical property. Business investments are also possible. Canada encourages foreign investment in its businesses. U.S. investors can invest in startups or established companies. This can be done through venture capital or direct business partnerships. Opening a brokerage account is the first step to investing in Canada. Many U.S. brokerage firms offer international trading options. This allows investors to trade Canadian stocks and other securities. Some popular firms include E*Trade, Charles Schwab, and TD Ameritrade. International brokers can be helpful. They specialize in facilitating cross-border investments. These brokers offer expertise in navigating different markets. They can provide guidance on Canadian securities and regulatory requirements. It's crucial to choose a broker with experience in Canadian markets. The account opening process is straightforward. Investors need to provide identification, such as a passport or driver's license. They will also need proof of address and tax identification. This information is necessary for complying with international regulations. After opening an account, investors can start trading. It's important to understand the fees involved. International trading may come with higher costs. Investors should compare fees across different brokers to find the best deal. Section 4. Key considerations: currency, taxes, and regulations. Currency exchange rates play a critical role in international investments. U.S. investors must convert their dollars into Canadian currency when investing. Fluctuations in exchange rates can impact returns. Keeping an eye on exchange trends is essential to mitigate risks. Tax implications are another key consideration. Canada has tax regulations that differ from the U.S. Investors may be subject to Canadian taxes on dividends and capital gains. It's important to understand these tax obligations. Consulting a tax advisor familiar with cross-border tax issues is advisable. Investment regulations must also be considered. Canada has specific rules for foreign investors. These include restrictions on certain industries. Understanding these regulations is crucial to avoid potential legal issues. Investors should ensure compliance with Canadian laws when making investments. Investors should stay informed about any changes in regulations. This includes both U.S. and Canadian investment laws. Keeping up to date helps in making informed investment decisions and avoiding legal pitfalls. Section 5. Practical tips for new investors. For new investors, diversification is key. Spreading investments across various sectors and asset types reduces risk. It balances out potential losses in one area with gains in another. Diversifying in both U.S. and Canadian markets can enhance portfolio stability. Consulting a financial advisor can be beneficial. An advisor with experience in international investments can provide valuable insights. They can help in understanding market trends and investment options. This guidance is especially useful for navigating complex tax and regulatory landscapes. It's important to start small. Begin with a modest investment to learn the ropes. As confidence and understanding grow, gradually increase the investment size. This approach helps in minimizing potential losses during the learning phase. Finally, staying informed is crucial. Regularly reading financial news and market reports can provide a better understanding of market dynamics. This information aids in making timely and informed investment decisions, ultimately maximizing returns.